the regular meeting of the Retirement Plan Subcommittee for September 6th. Thank you all for attending. I hope you guys have had a good summer. I can't believe it's almost the middle of September. But why don't we go? Does anybody have any comments on the minutes? Otherwise, I'd take a motion to accept as submitted.
I think we should technically table them just since there's not a full quorum.
Oh, okay. All right. So we can wait on that. I'll just mark that. We can follow back up on the minutes when Bert joins. And I guess we can turn it over to Chris and Tyler. Appreciate you guys joining us this morning.
Great. I think I'll start. Good morning, everyone. Great to see folks. As mentioned, surprise, we're here in mid-September already. For those of you who had an occasion to glance at the materials, you'll notice we did organize them a little bit differently, given so much time has elapsed since the end of June. We did provide, I think that Melissa's got it highlighted right there, some July flash information. We thought we'd try to link together June and July and just make the conversation a bit more topical, if that's okay. And then we have a couple of other topics to work through with you, as you see on the on our table of contents. We did have one potential action item, so in the absence of Bert, we'll table that for the time being and come back to it if we can. So with that, if we could, Melissa, if you were going to share, could you, or do you want me to share? What's easiest for you?
I'm fine doing it since I brought it up. Can everyone see it?
Yep.
Okay. If you want to just cue me, I'm happy to scroll through.
Okay, I can just cue you to the different pages if you would. So if you would scroll ahead in that section 1, it starts on slide 8, I believe, right there. If you could stop there, one back. Just to catch people up here, you see the exhibit on the top half of the page, which depicts returns for 2 periods. You see the encircled figures, which are the month of July, is designated in the upper left-hand corner. And more importantly, and probably more kind of consistent with folks' notions of what's going on, you see there the bar charts, the vertical bar charts. And obviously, it has been some pretty difficult sledding in the capital markets calendar year to date. And really all of that angst, I think, as you all well know, has centered on very high inflation, the Fed trying to stamp that inflation out, doing that predominantly by moving interest rates higher, as you well know, and then moreover, starting to reduce their balance sheet. And obviously, the situation in Europe with the war didn't provide any level of comfort to investors for sure. So you mix it all together there, and you do see a pretty challenging environment for the 7 months ended in July. But these peaks and valleys, and you see that in the July numbers themselves, where we actually had a fairly constructive month, centered on a couple of things. One was this notion that maybe the Fed was starting to get their arms around the inflation data, and we had seen some of that data begin to roll over a little bit, or at least settle at certainly high, but not quite as high levels. And then moreover, the earnings season that concluded just recently was a very strong one as well. So that gave some comfort to investors, and we had a good month of July there. August has been, unfortunately, more the same in terms of the downdraft, punctuated probably most recently, as many of you read, by the comments from the chair of the Fed at the Jackson Hole Summit, who said, we'll kind of continue to essentially go to any measure to stamp out inflation. And that set investors off on somewhat of a cautious path as well. So August, actually, we're down a bit in capital markets, anywhere between 2 and 4%, depending on what segment of the markets you're looking at. And obviously, the calendar year to date numbers remain challenging. If you could, Melissa, just the very next page there, And this is similar. I'll point the committee's attention, if you can see the upper left-hand corner, just to link in the month of July. You do see there, if you can make it out, very upper left-hand corner. All three of the pension plans, town, Board of Ed, and police, were up just a little bit shy of 5% in the month of July, about in line with the broad markets did. And then you can see the longer track record here, which I think you're largely familiar with and kind of running akin to what's going on in the broad markets, just to give you a sense of performance. Lower right-hand corner of the page from an allocation perspective, again, using the town plan as our proxy, but the relationships are similar for the other two plans. You see there the allocations largely are essentially in line with target weightings. We have been recently, when we've needed a little bit of liquidity, most recently the end of August, we worked with Amy on raising a little bit of money in the three plans, knowing that the work on the contribution front with Milliman is still in progress. But I think from a larger allocation perspective and just what's going on in markets, the type of numbers that you'd probably anticipate. And if you could scroll, and I'll pause in a minute, I promise, if you could scroll, I think 2 or 3 pages ahead, Board of Ed information, again, parallels, as does police plan. One more page should have the OPEB, Melissa, just to give the committee that perspective. So you see there again in the upper left-hand corner of the page, a little bit higher performance in the month for OPEB, 5.8%, if you can make it out, again, very upper left-hand corner of the page. And then from an asset allocation standpoint, you see in the lower right-hand corner, allocations running reasonably close to your standing strategic target weights. Let me pause there for just a minute on the July updates and see if there are any questions from committee members, and we'll spend a little bit more time on the portfolios momentarily on a few more items. But anything big picture for folks of interest or concern?
Chris, I was just wondering what the consensus was by the Fed, or if you know where they're targeting rates. Is it 3 to 4%? We've kind of seen, and I don't know if it's really related, but the 2-year has been inverted for, quite some time now. And I don't know if that's of concern to the broader market. It doesn't seem to be. But what are the target rates for the Fed?
Yeah, that's a great question, Eric. We actually have, if you could, Melissa, scroll ahead here in the deck just a little bit. One more page, lower left-hand corner, Derek, to your question, you see there kind of what the markets have been doing. And to Derek's question on what the markets know as terminal rates, right? Where does the exercise basically stop in terms of rate hikes? And that number continues to be in flux. And as you all know, as markets try to handicap pace at which the Fed is going to raise rates. And you see here when we ran this exhibit, kind of an interesting at the end of the first quarter, if you can make out the seafoam colored lines there, and if you can see right down below that, the actual expectations centered at that point in time, not too long ago, right? Somewhere between 200 to 250 basis points, as Derek points out. We're obviously there now, and you can see what happened as recently as the end of the second quarter, where the markets had kind of dragged, both the expediency of that rate hike and where they ultimately end a good deal higher and centered on 3 to 350. Even these numbers have become a bit dated now. I think the last, Derek, I saw was something like maybe a 375 as a potential terminal rate for when the Fed may stop. Okay. We'll see where that plays out, but that's kind of where market expectations are today. And this is obviously front and center, right? And what investors are going to figure out. But I don't know if that helps the question or not, but it gives you.
No, very much so. Sorry to jump ahead. I guess you were going to get to it, but thank you. You had mentioned the Fed, so.
So, the other big thing, right, is, Derek, you mentioned it, inverted yield curves, right, frighten investors and markets because historically they've been associated with recessions, right, more often than not. And we have had a sustained period of the yield curve inverted. If you could, Melissa, jump to the very next page. This might help a little bit as well. Actually, let me pause there just quickly, just to show folks two things here. It kind of fills out. It's a good interim point for us. So to the point of inflation, upper left-hand corner, one of the things that the Fed's worried about, right, is consumers, investors, and others anchoring to these much higher than historical inflation rates, right, with 8%, 7 and 8% type of numbers, way north of where they historically run. Break-even inflation you see measured on the page here and in the exhibit in the upper left-hand corner is the market's expectations on a go-forward basis on where inflation may reside. And interestingly, right, they are not anchored higher to those levels that we see today. And this, I think, has provided the Fed a little bit of a runway and comfort along the lines of we're not getting that anchoring behavior, right, where inflation becomes so nettlesome that we can't get it under control. So I think there is a notion, right, that there's an ultimate path to more reasonable inflation, and inflation, that we're much more accustomed to seeing, and call it that 2.5% range long term. So just another point of reference there. And then the other thing I would just point out here to the notion of a recession, right? Lower left-hand corner of the page is interesting, leading economic indicators. You see what we've done there. We've highlighted previous economic slowdowns with the gray vertical hashes, and you see invariably, right, leading indicators turns fairly meaningfully negative alongside those as real slowdowns in economic activity. And in the far right of the exhibit there, while you see leading economic indicators rolling over a little bit from their recent highs, they haven't just yet anyways turned sharply negative the way they have historically, again, alongside the onset of a recession. And again, just another data point or collection of information, if you will, that I think investors are hanging on to, that maybe we get a recession, maybe we don't. And even if we get a recession, perhaps it's relatively mild. I think you all know, right, we have had 2 consecutive quarters of negative GDP growth, really modestly negative, just negative, but negative nonetheless, which, as you'll probably all remember, is kind of often thought of as a layperson's definition of a recession. If you could quickly, Melissa, jump to the next page, and then we'll transition over. I'm sorry, go ahead one more. Might be the next page. There it is. So there's, to Derek's point, in the upper left-hand corner of the page there, you can see kind of the belly of the curve inverted with the very, call it the fronter end of the curve, softening into the 10-year. And you see those kind of quirky yield curve that exists today. And again, right, and watchful eyes cast towards the shape of the yield curve, because that inversion, again, has been historically at least one of the ways that, or one of the things that have flared up when we get an economic slowdown. Let me pause there. The data behind this, we looked at the July numbers and the allocations, and you saw the longer dated numbers there. And there is a whole host of information here that brings us through June. I think in the interest of time, because we had a couple other things we wanted to tackle with the committee this morning, I'm happy to go through that information in detail, or maybe defer to the chair and the other members if you think you've got a reasonable handle on the performance and market front.
Yeah, I think second quarter data, Chris, and this is just me. I think there's some of this data is from May, some is from June. We saw a summer bounce, and I think third quarter data will probably be a little bit more telling in terms of where the market maybe settles in, and certainly fourth quarter. I mean, I'd ask the rest of the committee if they were interested in hearing more, or if we should move on, or is there any other questions?
I think we should. This is Tom Potter. I think we should just move on. The markets, the past 3 months are kind of history, and I think the forward-looking thing is probably more important. So I think to review the past is not really useful.
Okay, thanks, Tom.
No, I think that's good
We can move
perspective,
on.
Tom. All right, let's, the other things we had with respect to the pension and the OPEBs, we did want to, could you go jump, I think it's your slide 23, Melissa, if you jump to that, we have a section there and a couple of things we did want to review. This is the quarter where we recast or review the investment policy statements for the pension plans and the OPEB. So if you begin to scroll, Melissa, ahead in the deck, you'll see we've inserted, that's just our framework there. We've inserted the policy statement. We do have one small recommendation for the committee to consider this morning. You'll remember you have a small in the pension plan, small standing positions in the Credit Suisse commodity total return strategy. And over the summer, there was some turnover with the management team there, and our research team did just recently elevate that strategy to terminate, which compels us obviously to bring you alternative ideas or other things to consider. So really the only, this will kind of come full circle momentarily, but you'll see there that the IPS is by and large for the pension plans in very good working order. And in the lower right-hand corner, you'll see the only thing that we're contemplating, to the extent that you agree to it. If you scroll ahead, Melissa, a little bit here in the content of the IPS itself, and keep scrolling down, you'll see there at the very end of this, it's probably 4 or 5 pages deeper, you'll see just the allocation exhibit for the pension plans. Might be one, there it is right there. And just a couple of things in terms of edits to bring us full circle from the previous version. One, you'll remember we did eliminate global bonds from the program a short while back. So you see the elimination of that category there in the fixed income benchmark a reference section. Just a small change to accommodate the fact that your real estate strategies held up pretty well, and certainly versus some of the risk markets like equities and whatnot, has been pretty defensively postured, and thought it probably made sense just from a range perspective to have a little bit of a higher range there, just in knowing throughout the course of a return cycle that strategy from a size standpoint will bounce around a little bit. No changes to the target weight. And then where it gets a little more interesting, we do have a recommendation for the committee. So you'll remember in the inflation protection portion of the program, you've got 2 strategies. You got the aforementioned Credit Suisse, which is elevated to terminate. And then we've got a TIP strategy, Treasury Inflation Protected Security Strategy. And they've both worked perfectly fine through time. But again, with Credit Suisse on terminate, we had another idea for you. And the thought that's germinated from our research team, which a lot of your in our conversations this quarter, many of your peer towns have begun to adopt, and we've seen it elsewhere in our practice, is using a diversified real asset manager that can do things beyond just tips and commodities, can do things like infrastructure equities and natural resource equities and the like. And the appeal of that strategy is that broader footprint as the inflation regime through time morphs and evolves, and different segments of those markets do better as the cycle matures. The thought in hand from our research team is having a capable manager that can run across the entirety of the real asset spectrum is a more flexible and perhaps return enhancing way to play that evolving inflation landscape versus the more segmented approach that we've used previously with the tips and the commodities explicitly. So again, I'll show you a manager that we would at least have you consider. To the extent that it resonates with the committee, you'd see there we would just make small alterations to the IPS. Again, the larger strategic allocations, as you see there, not changed really whatsoever. And the motives and objectives of the pools don't change whatsoever. It's just a little bit under the hood, trying to refine a portion of the portfolio into a higher conviction idea that our research team currently holds. So that would be a proposed edit for the IPSs. Again, the bulk of the IPS is in good working order beyond the allocation exhibit. If you could, just because it's front and center, Melissa, quickly jump to page 40, your slide 40. What are we on there? I'm sorry, scroll ahead if you would. A couple more pages. I must have written that down incorrectly. Little bit more. There we go. Thank you. Right there, real assets. So there's some information. I don't know if the committee members had occasion to review it or not, but we provided some search summary information for the preferred manager and diversified real assets that we're using currently. It's an organization, a DWS is the manager. And we did provide you a host of statistics in here and a summary description of what they do. Again, as I mentioned to you, they have a full-scale dedicated 30-person team, real asset a portfolio complex, if you will, with a pretty experienced group of individuals doing that work. And we can get that exposure in one fell swoop with a single institutional mutual fund. And we think do so pretty successfully. So the thought would be in the 3 pension plans to take out those small positions in Vanguard Tips and Credit Suisse and just swap them for the DWS strategy and use that as our real asset expression going forward. Let me pause there for a minute. I know I threw a lot at the committee there and see if that maybe resonates with folks a little bit.
Lisa?
First of all, thank you for that suggestion. One of the questions, and you may be getting to that later, our OPEB investment policy statement that we have online is from 2007. So to the extent that can be, I don't know if we've got the right one posted online or if it needs to be updated.
Yeah, I think we found one, Lisa, and I meant to Amy to track you down on that. I think we found a more current one. We included it here in the deck. We'll share it with you momentarily if that's okay. But we did find one that was a bit more current.
And then just in terms of the real asset, is there any, I mean, you read on the news, is there any, would there be any pushback? Is this investing in multi-unit housing? Is this?
Yeah, no, they typically center on, from a strategic standpoint, they do a lot of natural resource equity, right? So that could be, the host of organizations you can think of there that are working in that field. They do invest in tips directly. They do invest in commodities when they think there's value there directly. I don't think that the housing situation, Lisa, is something where they've gone to very often, if at all, in terms of strategy. And it's just a way from our standpoint, right, to, the inflation environment, as you all know, is very much in flux, and you will see probably going forward, if history is true to form, this sponsorship into these different segments of the markets. And in our mind, and the inflation front, the real asset front, and in our mind, having a good, capable manager to help you navigate that portion of the portfolio into those areas of strength and value and return opportunity, as opposed to the more segmented, static approach, if you will, that we'd had previously, just makes eminent sense, again, given some of the volatility we're seeing in the inflation arena.
Amber?
Chris, did I hear you say, when you were talking about the types of assets that this real asset manager would be investing in, did you mention energy?
Yeah, absolutely, Amber. If you could scroll ahead, Melissa, if you would, there's a fact sheet for the fund itself. And I apologize because I know these keep scrolling ahead, if you would, to Amber's question. Here's some numbers here, just out of curiosity. you'll notice there at and I'll come to Amber's question, I promise, upper left-hand corner, you see the strategy through June is annualized at about 8.1%. So pretty consistently above S&P real asset bogey. The mix of managers that we've got or strategies we have currently 5 years ending in June had annualized at about 4.6%. And just kind of an interesting comparison there, right? So I do think that there's a proof statement around this manager's ability to navigate on the fringes a little bit. But Amber, to your question, if you could, Melissa, scroll ahead just a page or two more. You should keep going. I know we've got a bunch of stats here. One more page. You should see in the upper right. Yeah, can you make that out? If you can, Amber, to your question. So you see there a little bit, and we can get you the detail there, but you get a flavor, right, with the sector allocations in the upper right-hand corner at 630. And then moreover, the top 10 equity holdings, you see there right next to it on the left, you get a little bit of a flavor for the complexion of strategy. So they very much are doing energy under the hood, to your direct question. You see a little bit of that again, right, with some of the names. But just,
and I guess I would just throw out to the committee that would be a question as to whether we would want to consider what types of energy this is investing in, how we feel about that, giving considerations to, I mean.
This is Tom Potter. Don't we have a fiduciary responsibility to provide the best returns to the participants? And so while we may have a view on ESG, that ultimately the maximizing the returns is more important.
Yeah, I would only piggyback that by saying we don't have an ESG strategy as a committee as well, or as a town. So I wouldn't start picking individual stocks or having an opinion on a broad-based real asset strategy.
All right, I just threw it out there as a consideration. I don't think I've heard the committee. I didn't know what the committee's position was on this, or if there was any kind of strategy around that type of investment. So I'm really just asking just to clarify that question. And that's all.
I get follow up, Chris. It looks like there is a pretty significant crossover. I mean, up to 25%, although only a target weight of 3.5% of real estate. So there could be some, I guess, minor crossover from real assets and real estate, which I guess makes sense, but not enough to really move our target over our max weight by any means.
Yeah, that's correct, Derek. And we're mindful of that as well. Actually, we'll do this again for you in short order, right? As we come into year end, when we recast the allocation constructs for the plans and marry them to our capital market inputs. But I know in our kind of our running allocation exercises we've been doing, that the model does pick up that crossover, as you mentioned, between dedicated real estate and its form under the hood within diversified real asset. And the model works perfectly fine from an optimization standpoint, having a little bit of exposure to both alongside.
Okay.
So
I'd like to return to Amber's question just to ask. I don't recognize the names of the energy companies on this list. So could you just, if you know, tell me what kind of business they engage in?
Yeah, I think, Bert, right? So I think that DWS will this may be a way to try to tackle it, right? DWS will invest these assets, not really with an explicit mindset towards, what portion of the energy complex the managers are running in, right? Their MO is on, kind of finding attractively priced, reasonably valuation type securities and hoping to generate, to Tom's point, ambitious and a strong total return on a go-forward basis. And when you talk to our analysts, right, I think what you found a lot of the managers say to the point of ESG and kind of where within the spectrum they are, refiners, middle market, wherever they may be, that a lot of the managers, DWS included, have begun to score those opportunities with their points of focus, and be aware of if the companies are operating, if you will, as good citizens, if not in an explicit manner, certainly a notion of that. So they operate across the entirety of the energy complex. I tell you, there's not a explicit awareness here to ESG, if that's the committee's concern. They're going to where they think there's the best return opportunity on a risk-adjusted basis, is the blunt answer. So that's, I think, unfortunately, that's the best I can do for you on that front. And hopefully that helps a little bit. The other thing, because I want to be sensitive to time and the rest of your agenda. The other thing we started to do for many clients, and we're happy to do it for the town as well. We do have a mission-aligned investment committee internally now, and among their charges is ESG awareness and kind of scoring investment managers along those rough lines. And we can do work explicitly in your portfolio to give you some feedback and notion of how the different managers are tackling mission-aligned, ESG, DEI, however you may want to label it. And that could be an interesting exercise for us at some point in the future if the committee agrees. We've had a couple of your peer communities ask for that type of analysis. And we do have a full-scale effort now, knowing that it's becoming an increasingly important topic of interest and consideration, at least for committees. But that's just an aside. I just thought I'd mention that. I don't know, Bert, if that helped or not, honestly, but
It helped a little.
to the extent there are particular names or something at some point, I can certainly get under the hood with our analyst who covers them and is obviously talking to them much more frequently than I.
Thank you.
So I guess I would ask the group, if this is something that we want to act on, or if people would like to take more time to read into the fund documents here, or whether they want to do more digging into the top equity holdings in the companies, as I think Bert may have wanted information on. I'm inclined to defer to the experts, but I would ask the rest of the group if they would like to wait to act, or whether this is something that we're willing to make a change now on.
This is Tom Potter. I'm inclined to go ahead and act on the recommendation.
I'll field the motion to accept the changes and make the recommendation to amend Exhibit A to the policy statement, the DB policy statement.
I'll
So
second that.
not hearing one, I would assume that people would rather wait and do some more digging and have a more substantive conversation the next time we meet on this, or we are, I guess, in other words, rejecting the recommendation. What is the
Derek? I'll second your motion.
I didn't make the motion, Tom. I'm still waiting for a motion, and then I'd be happy for you to make the motion and wait for a second.
Yeah, I'll make the motion that we move ahead with the recommendation of our consultant.
Derek, just point of order. This would still come to the Board of Finance, so it would be the recommendation to the Board of Finance. So there would be a second look at that point at that time as well. That helps with consideration.
Yeah, thank you for that, Lisa.
I guess I would like to just ask a question if I could. It seems like we could move forward with this recommendation and still take under consideration at a later time whether we wanted to do this type of analysis, correct? I mean, we're not having to preclude that option down the road.
Correct.
That's right.
Correct.
The analysis would probably be more meaningful.
Oh, Bert, I
lost
think
you,
you
Bert.
cut out.
Yeah.
I said, I was just saying that the analysis would certainly be more meaningful if we had it before we made the decision to make the change.
I'm sorry, I still didn't hear you, Bert. I apologize.
I don't know if it's me or the computer. Can you hear me now?
Yes.
Yeah.
Yeah, I was making an observation that wasn't worth waiting for, but I was going to say that the analysis that Amber's talking about would be more meaningful if we had it in our hands before we voted to make the change.
Okay, thank you. Usually we'd get a second and then discuss, but still waiting for a second here, and then we can discuss further if you'd like. Is the chair able to second? Because I will second. I will second the motion. Any discussion, further discussion? Again, this is just a recommendation to the Board of Finance. And again, we'll have time to make additional changes, or if we decide that we want to change it in the future, we can. All those in favor? I'm sorry, Amber?
I was just gonna, I mean, I guess I'm just explaining my vote. I would vote to recommend this to the Board of Finance, but I would like to see us do this type of analysis in the future.
You would you accept a friendly amendment to include a vote to refer this to the Board of Finance with a recommendation to do this analysis in the future?
Can we be more specific as to the analysis?
Chris, if you could guide us on that.
Yeah, so what our team does is they will run through the entirety of the roster, the investment manager roster that you have in place today. And they've developed a grid with a series of criteria that relate to, for lack of a better term, I use good citizenship, right? And they will score based on ESG considerations, based on DEI considerations and the like, and they will deliver to you, we'll deliver to you in summary fashion a grid that shows you to what extent, in our estimate, these different underlying strategies and managers are running their strategies with an awareness of and a sensitivity to a lot of these considerations. And it's helped a lot of your peers, I think, get their arms around, how these different managers are operating in those environments. I will confess, right? I don't think it comes. There's not a pass or fail criteria that's delivered at the end of the analysis, but you certainly will see visually across the 8 or 9 different categories that we're looking at to what extent the manager from our analysis is fulfilling the responsiveness to those different topics and items, if you will. So it's a way I think people get comfortable with where we're investing with considerate, thoughtful managers that are kind of aware of this landscape and how it's evolving through time. I think to Tom's point, right, I think the guy that's not done in a vacuum away from the fact that we still need to hold the managers to a performance standard ultimately. And that obviously remains a very important part of the analysis. But this additional exhibit, if you will, I think from just a due diligence and a bigger picture standpoint, have provided a number of your peer your committees around the state a level of comfort, that the managers are sensitive, to these issues, and have found it a kind of a useful thing to document and tabulate and have on file.
Yeah, and if nothing else, Chris, we can at least say that we've looked at it internally for maybe some beneficiaries that have questions about it. I guess I would just clarify that this analysis would be benchmarked. I guess you'd see it against each other as peers, but also against benchmarks, both within the more business-friendly or ESG-friendly arena, as well as more broadly against the broader market. Is that fair?
Yeah, I think it is, right? I would say also, right, and the committee can appreciate this, I'm certain, right? There's a more of a qualitative element to this, right? Because the landscape is still being defined, and what may be important to the town of Simsbury might not be as important to the town of Avon, right? So there's these kind of evolving considerations. There aren't hard and fast or right answers. So that it does kind of lean into our analyst teams kind of working through their guideposts and developing this, I would admit, is more of a qualitative analysis of adherence to these principles and an awareness to these type of issues, if you will, than it is a hard and fast score. But again, it goes in hand, Derek, to your point, to Tom's point, right, alongside the numbers ultimately, right? Is the manager generating competitive performance net of fees ultimately is certainly an equally important consideration. So I think armed with that information on both sides of the ledger is what'll maybe get the committee over the hump a little bit on some of this ESG stuff.
Yeah, and just to Tom's point, I don't know if we would need a legal opinion as to what our fiduciary duty and what we can consider without an ESG or DEI investment policy, or just in terms of what our obligations are. I think it would be helpful to get that analysis as to what types of things our board can consider and what policies it would need if it chooses to consider other things.
Could you just remind me what the ESG and DEI, what do they stand for?
Yeah, ESG, environmental, social, and governance, Art, is kind of where the conversation started, right?
Yeah.
Companies good citizens? Are they not polluting the environment? Are they treating employees well? DEI, diversity, equity, inclusion. What percent of management might be minority?
Right.
Top things would just off the top of my head be what we're surveying on.
Thank you.
If this board is interested in that, we could request that at the next Board of Finance meeting for council review as to what our obligations and duties are regarding that.
I would like to have that question answered.
Okay.
Yeah, I don't know do we have, I think we would know if we had any obligations, right, Lisa?
Well, in terms of our duties, what can we consider? To Tom's point, is it the return? We have a fiduciary duty to maximize return within our risk capacity and tolerance. And so the question is, what other factors can we consider within our fiduciary duty? And what policies do we need if we want to consider other factors, I guess, would be. I mean, it's multi-pronged. It may be that the Board of Selectmen decides whether to adopt an environmental, social, and corporate governance policy, or is it the Board of Finance? I don't even know who would adopt that. But I think we would need some legal guidance there.
Okay. So full circle, we have a motion and a second. Any further discussion?
Could you repeat the motion? I'm sorry, I'm not sure what we're voting on now.
To paraphrase, Tom Potter made the motion to take Fiducian's recommendation to replace the TIPS or inflation protection investments with the real asset investments by DWS.
Right, and to recommend that
to the Board of Finance.
That action to the Board of Finance. But I think Lisa also proposed an amendment that would send the recommendation along with the analysis that Chris just described.
So technically, I can't propose the amendment. I just offered it as a suggestion. I'm not a member of this committee. I'm a guest.
Oh.
If you are interested in that, we could do that. Or we could do that at the Board of Finance.
It seems like the committee is interested in that. So with that amendment, that the analysis be done prior to sending it to the Board of Finance for consideration.
Right.
That's the motion. and it's been seconded.
Thank you.
So I'll take a vote. All in favor?
Aye.
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 Hi. I'm not a member. I'm sorry,
Aye.
I can't vote.
Any opposed? Hearing none, the motion passes unanimously. Thank you. We can move on. Thanks, Chris.
Great, thanks, Mr. Chairman. The only other thing quickly, I do obviously want to give Tyler all his time that he needs. On slide, I believe, Melissa, it's 50. Hopefully I wrote that down correctly. I think it's slide 50 in the deck. Was it Lisa who asked the question on the IPS for the OPEB, which is in good working order from our standpoint. And you do see here, we've got from May of 17, an IPS signed by Mr. Cook. I think if you scroll through, Melissa, you'll see the entirety of the document. And from our standpoint, anyways, it's in pretty good working order, both from an allocation and a content perspective, and continues to be an effective blueprint for the committee in terms of oversight. And, feel free to scroll through it here, but we didn't have any recommendations this morning to the committee. I think we're in pretty good working order. And remember, we don't have the issue with the real asset here. We've got a slightly different construct in the OPEB allocation than in the legacy pension plan. So I think we're in good working order, and the 2017 copy as executed is the latest version that we had on file on our side.
A question for the chair. Would the chair consider a motion affirming the policy as of September 2022, so it doesn't look like it's a 2017 document? It would then be affirmed of the current boards.
Yeah, I would very much consider that, taking Chris's fiducian's comments into consideration regarding that thing existing in good order. I guess my question, it's really for you, Lisa, and you may know better than I, how often this needs to be updated. Is it on a 5-year or 10-year basis, or is it just as needed?
Board had talked about doing reviews every 5 years, so this would be updated in 2023. If you want to wait a year, we could do that as well, because 2023 is 6 months away. If you want to do that for next year, I'd reach out to Amy on that as to her recommendation.
I'd be inclined to do it now, but Amy, if you have any ideas, that's fine with me.
Yeah, no, I have no preference. Now is good.
And I would just note through the chair too, as this is part of our governance calendar as well. So we look at it at least annually as well, just to make sure from our standpoint it's in good working order. But obviously defer to the town on the formal approval process.
Yeah, so I think this is something we could probably take action on today as well. I guess I'd be looking for a motion again to affirm the policy statement here from 2017 to be updated really just with a date and that it's been reviewed as of September 2022. And again, that would be sent on to the Board of Finance for their consideration. Do I hear a motion?
Make that motion.
Thank you. Was that Amber?
Yes.
Okay, Amber made the motion. Do I hear a second?
Second, Bert.
Thank you, Bert. Any discussion or comments on the policy statement or the motion? Hearing none. All those in favor? Aye.
Aye.
Any opposed? Hearing none, we'll update, or we will send that recommendation on to the Board of Finance. I guess the only administrative item is we would need to know, I guess, who the Director of Administrative Services currently and get that signature or the approval signed by the right person at town. So thank you for that. We can again move on.
Well, great. I think that absent any other questions from the committee on the pension or OPEB front, I think Tyler, you slide 61, I think, for your section.
Yeah.
And Melissa, we can go to the next page there. Good morning, everyone. I hope everyone had a great Labor Day. This is our defined contribution governance calendar. So I'll speak a little bit so obviously we always review the investments, but this Q2 is when we take a deeper dive into the types of investment options that you currently offer. As this is a participant directed plan, you want to be able to say you offer the right types of plans, and how does that benchmark against other plans as well, because there's a lot of investors in the target date funds and they do represent the default investment. We take a little bit of a deeper dive into how the target date funds work. Those are the T. Rowe Price target date funds, and then I also included some trends and best practices. Before I go into the heart of the presentation, and I'll get us out with time. I know in about 2 more quarters, we'll be talking about the sort of regulatory and legislative update. I just want to kind of give you a crystal ball on what I'm hearing around Congress with respect to the defined contribution space. So there's been a lot of talk about Secure Act 2.0, and there's been a lot of rumors around what Congress is going to be tackling with respect to Secure Act 2.0 and how that will potentially impact not only the 401k for-profit defined contribution plans, but potentially municipality defined contribution plans. So a few things that Secure Act 2.0 will potentially impact. And again, this is hypothetical, but we are, and there's no slide for this, Melissa, I'll just talk to it. It's more what we're hearing about, and I don't want, prior to us reviewing it in Q4, anybody to be blindsided by the next, let's call it 4 months or so prior to the end of the year. So what we're hearing with respect to Secure Act 2.0 is the potential for increasing catch-up contributions across retirement plans. So right now, folks can contribute an added $6,500 north of age 50. They're talking to bumping that up to $10,000 when you reach 60. So 10 years later, getting it up to $10,000. The bigger impact that we're hearing is that they would be forcing all catch-up contributions to be a Roth or after-tax contribution. So that obviously would have a pretty significant change to the industry. And so all folks that want to contribute above and beyond the limit, aged 50 and older, would have to make that a Roth or after-tax contribution. The other impact is a potential to delay the minimum required distribution. So if you remember, for many years, the minimum required distribution age was 70 and a half. The Secure Act 1.0 bumped it to 72. The newest iteration of the Secure Act would potentially bump that up to 75. So, I think people are retiring later and obviously living longer. And so delaying that would have a better tax consequence for individuals. The last, and I think most impactful change that has been proposed, and you can kind of get a theme that we're going through with Congress here. They're looking to allow for employer contributions to actually be a Roth contribution as well, or after-tax contribution. So essentially what would happen would be is if you were matched or given a contribution and you elected that to be a Roth contribution, you'd be taxed on that from an income standpoint. So you can clearly hear that Roth is the theme for Secure Act 2.0. More to come on this. None of this is finalized. I just wanted to talk to it just in case, next couple months that gets passed and we're not addressing it till after the end of the year. So any questions on that before I begin? Perfect.
Thanks, Doug.
Yeah, sure. On 64, Melissa, on your two pages down. Perfect. So this is a good opportunity to look at what types of investment options we're using within the retirement plan. How are they utilized or underutilized? And so how you read this page is what we call our gap analysis. Is from left to right, you have sort of the multi-asset stock bond mutual funds through the T. Rowe Price target retirement funds. Most heavily utilized fund, obviously by participant and by asset. You then see capital preservation through the Mission Square Advantage Trust Plus fund. So that obviously preserves capital with the crediting rate. Then within fixed income, you have two options, an active Western asset core bond, and then the index through Fidelity. And then in the blue area, you have a mixture of both active and passive investment options across small mid value, large growth, small mid growth, as well as the core space. So people have the ability to invest in both active managed investment options as well as passive index options. And then obviously in the global international, you have both active and passive. And so instead of us just saying, okay, you have, call it 20 different investment options, you really have to think of this menu as a tiered investment menu. So the first tier is the sort of, I want someone else to do it for me. And that's the target retirement funds. It invests based on someone's age and obviously decrease in risk as you approach that retirement date. If that's not a right fit, there is indexing strategy across fixed income, all of the different style boxes in U.S. equity as well as international, so that someone could completely asset allocate utilizing the lowest cost indexing strategies through Fidelity. And then finally, active management. So people who believe strongly that active management over a longer period of time can add value above and beyond the index. We have the ability for folks to invest in that. So it's really kind of a three-tiered investment structure. Again, some people can have a combination of obviously indexing and active management as well. If you go to the next page, really quickly, we just like to take a look at what your plan looks like compared to all of the other plans in the industry. And Plan Sponsor Council of America does a great survey across thousands of different plans on what types of asset classes are they offering within the retirement plan space. And what this can do is it says it lines your plan up with peers. It also can ask the question, okay, if a lot of other plans are offering this asset class, why isn't the town offering that asset class as well? And actually, if you draw an invisible line down the 50% mark, and all this says is, for instance, the top line, 90% of the plans surveyed offer a active domestic equity investment option, which is obviously something that you offer. And if you draw an invisible line down the 50% mark, you actually offer all of those. That's your investment menu. You offer active domestic, you offer indexed or passive domestic equity, active international target date funds, active bond, et cetera. So you're offering all of those different types of investment options that are in a majority of defined contribution plans. And you aren't offering the asset classes that are, say, not typically offered in plans. So for instance, if the question today was, why don't we offer international bond or even ESG, you can see in the bottom there, you can get an idea of how many other plans like yours offer those types of asset classes. So now again, just because it's the majority and just because I say it's in the minority doesn't mean that's the right answer, but I think it does help as a data point build out the investment menu itself. And then to the right side of this page, you get an idea of how many plans offer target date funds as their default option. And you can see that's 86% of sort of plan participants gravitate towards those target date funds, which again, tend to be the go-to or default of choice across the industry. Any questions so far? On the next page, I just did a brief write-up on questions, comments we're seeing around menu design. And I know this actually just came up, but on the top right there, we are hearing more and more individuals ask about ESG investment options. Now you have the ability through, say, pension assets to, if you wanted to, and we have clients who've done this, or endowment foundation clients that completely scrub their investment menu through an ESG lens. Now, that's not typically something we see in the defined contribution space, clearly, but we are seeing. Let's say there's some sort of mission alignment that you do on the pension side. You can offer investment offerings that correspond with that with that mission. A good example for that, I guess will be the easy example. Sometimes it's tougher to find that mission through municipalities or maybe the corporate 401ks. But let's say you're a hospital or say the American Cancer Society, and obviously want to offer a no tobacco investment offering through the defined contribution plan, and we have the capabilities of doing that. I will say utilization is fairly low. Typically, we don't see a lot of people just rushing towards ESG funds, but we are getting the question around why don't we have these types of funds that say exclude tobacco, exclude firearms, or obviously low carbon environmental impact, et cetera. So happy to assist with that on the defined contribution space as well. And the bottom right there, we probably would have laughed last year talking about this, but we are getting more and more questions on why cryptocurrency isn't in a defined contribution space, especially given that Fidelity recently created an offering through the 401k products that would allow for cryptocurrency exposure. The DOL very sternly wrote an open letter cautioning fiduciaries around offering cryptocurrency, obviously given the lack of long-term performance and the risk and the risk of fraud, et cetera. So clearly it's not something we're going to come in and recommend. Clearly it's not something that I think the defined contribution space is ready, but I will say, at least a majority of my clients have had the question asked by a participant, why isn't there some way for me to get some level of cryptocurrency exposure? So if we want to jump, Melissa, to slide 68 on your end, next page there. Technically, your plan is not governed by ERISA, but the DOL does provide some guidance around how you evaluate and monitor target date fund investment options. And we've included those bullets here. I will note on the next page that the amount of participants gravitating towards these types of investment options. Sorry, Melissa, the next page 69 on your slide there. We are seeing over the last 10 years, the new money going into defined contribution plans to target date funds were about 35% of all new money. Now it's closer to 85%, which makes monitoring, evaluating these types of investment options that much more important. And so if you jump to 73 on your end, we include the T. Rowe Price retirement target date funds. Just a reminder, all target date funds have what's called a glide path, and all that is the decrease in risk or equities across the age of a participant. And so you can see or get an idea of what that glide path looks like through T. Rowe Price on the bottom left chart there, and then the obviously asset classes that they are leveraging. So early career, so anywhere from 20 to 15 to 25 of age, you can see that majority of the assets are longevity risk assets, large cap stocks, mid cap stocks, international stocks, and then some level of, say, of commodities and emerging market or high yield bond, emerging market bond. As you get to right around age 50, that starts to decrease, and the management process starts to add inflation risk assets. You can see tips, real estate, commodities, and then obviously market risk assets like investment grade fixed income and international fixed income. So this automatically happens over time. I will note that T. Rowe Price did adjust this glide path. They originally, with their team, built this in 2002, and they look back at the data. So if you think about how the glide path works, data goes into that glide path. It's how do participants behave? When do they retire? How long do they live? What do the capital markets do? And how much do they need at retirement? And then about 100 other different data points that go into that. I'm thinking of kind of the core data points. And so the concept behind that is if I'm saving at a particular rate from 22 to 67 or so, will I get to a place where I can retire? And a few things changed over that time period. since 2002, based on the initial assumptions that they were building this glide path out, which made them increase the equity across the glide path. Those changes were threefold. One was people were living longer, and so obviously there's a longevity component that you would have to increase equity to combat. Two, that people weren't saving as much as they initially thought. So their initial estimate was that people were saving around 15% of their income throughout retirement. It was really closer to 12.5. And so there's this idea of unfundedness that would account for higher equity. And then the final data point, they found that people in target date funds, in extreme event market volatility events, weren't selling out of the target date funds and buying into, say, money market, or that there wasn't a sort of fear investing that occurred maybe potentially in the do-it-yourself camp. People tend to stay the course, and if they were staying the course, T. Rowe Price felt like they could take on a little bit more equity, a little bit more risk. And so you can see on the next page that T. Rowe Price does, page 674 there. When we compare T. Rowe Price against all of the other glide paths in the industry, and you can see the blue mark represents T. Rowe Price. The dotted black line is the S&P sort of average index of the glide paths. And then the gray band is kind of the range of all of the other target date funds. And you can see T. Rowe Price obviously is on the higher end of that. They do take on a little bit more equity compared to the peers in the marketplace, and they'll continue to manage that risk 30 years beyond that retirement date. And so they'll continue to. You can see that line is at 2022. You can see all the way to 2052 that T. Rowe Price will eventually decrease those stocks and increase those bonds according to obviously people's age there. So they do not take on a little bit more risk. We often see plans with pensions, given that that's sort of the risk off assets, gravitate towards these types of glide paths as well. So we do think that T. Rowe Price's glide path and the data behind that glide path makes a lot of sense. If you look on the next page there, you'll note that with that, this is essentially showing you risk to return. Further to the right is risk. Further on the vertical axis is return. And so, despite taking on a little bit more risk than, say, the cross section, which is the average, they are getting the added return above and beyond peers over the last 5 years or so. And so you are getting that benefit despite the fact that you're getting and taking on slightly more risk from a glide path standpoint. I'll pause there to see if there's any questions around the target date funds. Perfect. I did include a few slides here. If you want to go to page 79, the two options that you can offer within a defined contribution landscape for capital preservation are stable value vehicles and money market vehicles. And we typically like the stable value vehicles, like your Mission Square Plus Stable Value Fund, because it typically gets a delta above and beyond what money markets can do. Why? Money markets are essentially invested in short-term treasuries, so essentially 99% government bonds, and can react very quickly with the changing rate environment. Stable value investments are typically pooled assets backed by insurance wrappers to guarantee the dollar that someone puts in, with an added crediting rate given that they can invest in slightly longer duration investment assets. The challenge that we're getting right now is obviously that yield curve inversion, where money market may actually outperform stable value for a period of time. Now, again, I know Chris talked a little bit about this prior, but that doesn't tend to last for very long. And we do like the smoothing of those rates over a longer period of time. And you definitely benefited having a stable value vehicle in a zero interest rate environment we had after, 08, as well as after the pandemic. But we are in that scenario where money markets may pay slightly more than, say, a stable value vehicle. I included some additional information around the stable value on your Melissa page 80 and 81, but obviously no recommendations for any changes right now. And we won't obviously do this because those two types of investment options are very unique compared to, say, a regular equity mutual fund. We want to spend it and have spent a slight more time this quarter than other quarters on those two types of investment options. I'll pause there. Any questions so far? So on page 82, next page, excuse me, you can get an idea of the balance of the assets. This is the 457 plan. So clearly with the market downturn, we saw a decrease in the overall assets. What I'm also looking for here is, are people moving in and out of different asset classes? Are they trying to time the market, et cetera? I don't see that. I don't see a big movement towards, say, the plus vehicles and the stable value vehicles. And so no big concerns, but obviously down from about 15.5 to about 13.5 as of the end of June. On the 457, stayed fairly, given there's a big, the Board of Ed plan, there's a significant pool of the assets in the plus fund. So stayed fairly static there with respect to the overall balance. I'm sorry, we're back on page 83 and then 84, the 401A as well. You get an idea of the overall balance also. So given, and Melissa, on 85, given the higher equity position, with the market downturn we saw last quarter and in the year, obviously some underperformance versus peers with T. Rowe Price, but longer term still either in line or above the index and actually doing quite well against the 10-year, not only average of the peers, but from a ranking standpoint, performing fairly well. So no concerns there on the T. Rowe Price target date funds. And then on the core menu, starting on page 84, some challenged market conditions for active management, not only within fixed income, but the U.S. equity. Some of the funds on the near term struggled a little bit. Longer term, though, still performing fairly well. With no significant concerns. So we do have all of those funds on maintain. We don't recommend any changes right now. The index funds are actually performing in line with the index net of fees as well. So no recommendations to change the menu. I'll pause there to see if there's any questions or comments around the investment menu or anything I spoke to with respect to the governance calendar.
Tyler, just quick question in terms of second quarter returns. I thought that maybe the returns wouldn't be as negative just because I feel like second quarter was somewhat buoyed by April and May. What are your expectations for third quarter data, given that we're almost at the end of the quarter?
Yeah, so a great question. So a good example is the T. Rowe Price Growth Stock Fund struggled pretty meaningfully over the year. They've recovered quite nicely. They're top decile, about 75 basis points above the index so far into the third quarter. Again, I think with the rising rates and inflation, some of the more growth managers struggled a lot. More active managers struggled a fair amount. But we're seeing some nice numbers come out of July and into August. And so I expect that sort of third quarter review to hopefully hold up a little bit more with some of the growth managers we have in the plan.
Okay, thanks.
Great. Melissa, that's all I had for today.
All right, thanks, Tyler. And thank you, Chris, as well. Thanks, everyone. We do have one more quick item is the minutes to go back so we can. Does anybody have any questions or comments on the minutes? If so, I'd be open to taking a motion to submit the minutes as presented.
So moved.
I'll second.
Moved by Bert, seconded by Amber. Any discussion? Hearing none. All those in favor say aye.
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 Okay, great. So the minutes are approved. And with that, I will take a motion to adjourn.
So moved.
Second.
All those in favor? Aye.
Aye.
Have a great week, everybody. Thank you. Thank you, Fiducia.
Thank you.
Take care.